Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those different ideas together. Though I'm typically coming to you from Morgan Stanley's London headquarters, today, like many of our listeners, I'm working from home. Hence, this may sound a little bit different. It's Thursday, March 19th at 8 p.m. in London. We think risk-reward is gradually improving. That's not because we're sure the sell-off is over. It may not be. It's not because the risks to growth or public health aren't serious. They're very serious. And indeed, our economists have recently updated their forecasts and are now expecting a recession both in the US and around the world. Rather, we're becoming a little bit more optimistic because a number of things on our checklist are starting to get checked off. First is valuations, which were unusually expensive going into this decline, but are rapidly moving to recession-like levels. Stock markets have fallen 30% in the United States, 40% in Germany, and 55% in Brazil. In the span of just 2 months, corporate credit spreads have moved from some of their richest levels in the last decade to their cheapest. Next is central bank policy, which after a slow start is starting to respond much more aggressively. When the Federal Reserve made an emergency rate cut several weeks ago, we noted we were concerned that the lower interest rates wouldn't have much of an impact on the current crisis. But since then, central banks have become significantly more active. The Federal Reserve has announced it will buy at least $700 billion of securities as it restarts quantitative easing. The European Central Bank announced it will purchase about $850 billion of securities as part of a new pandemic support program. And the Bank of Japan has stated it will increase its stock market purchases to a potential value of about $100 billion. There's also the fact that we've sold off unusually far, unusually fast. The history of prior bear markets and recessions suggests there are usually some twists and turns, even when facing serious, uncertain, unknowable challenges. That was true in 2007 and 2008, in 2001 and 2002, and even between 1929 and 1932. For all those reasons, while we are still equal weight in global equities and credit in our strategic allocation, we've started to take up the exposure within those bands. We are closely watching the final two elements of our checklist: more clarity on when the peak of U.S. coronavirus cases will occur, and, ironically, weaker economic data, which would shift our cycle models out of their current downturn phase and into the better repair phase, which indicates the start of a new, fresh economic cycle. In thinking about where to add exposure and where the bottom lies, we think the concept of sequencing remains important. In fixed income, we want to have an up-in-quality bias, as central banks can combat liquidity, or the lack thereof, but can't prevent a coming recession or prevent a corporate default cycle. That means buying investment-grade credit before buying high yield. In U.S. stocks, my colleague Michael Wilson thinks that the risk is now more around crowding in very popular stocks and sectors rather than in overall market levels. And for the market overall, we'd reiterate that the pattern of prior sell-offs is often that volatility needs to peak before overall levels trough. That hasn't happened yet, but is something we're watching very closely before raising our exposure another notch. Thanks for listening.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.